Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Coming out of a long weekend, Tuesday morning, and it's still all about Trump, what he says, what he does, etc., etc. Markets, though, looking much better. We're coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, good morning.
Hi, morning. Good morning, folks. And I guess this weekend was a much-needed relief and respite to disconnect from the maddening news flow, right? But of course, we're still following most of it. There was plenty of it, and I think the question that we'll be asking a lot of market participants today is whether the worst from a market perspective is over.
Well, it'll be difficult to answer that, right? Because you don't know what President Trump is going to do next. But at least some kind of a solution with regard to maybe a couple of countries, US and Japan, I think that holds the key. And that will give us a broad, trajectory in terms of how global equities could behave as well. Because Japan has the highest amount of debt, invested in the United States. So we'll have to keep an eye on that.
Absolutely. But 2 days worth of Wall Street action to react to. And,
that made for intense reading last night.
All right. Well, let's just take it from the top then in terms of the, the changes, really. So this is the last 2 days, basically Friday and then Monday, the sessions that we have to react to, the cumulative net change. The S&P 2.6 higher, the Nasdaq 2.7 up. You have the CBOE Wix, which has fallen 26%. I saw a comment from Treasury Secretary Besant this morning as I was walking in, saying that probably we've seen the peak volatility. And maybe that is right. I mean, just in terms of sheer gap up and gap down. I was saying this on Friday on Editors Roundtable. We did not know what markets will do Friday evening. But the average sort of range for the S&P 500 for the first 4 days of last week, Monday to Thursday, was 7.8%. Almost 8% range. I mean, this is just incredible. The macro markets now, the 10-year yield, 6 basis points lower. We saw a pretty large move last night, so that kind of netted out. -6. Dollar index about 0.85 lower. We are under 100 levels on the dollar index. Oil prices are up about 2.5% over the last 2 trading sessions. So, I mean, this is a very nice and comforting screen. It's all relative. What we had was an absolute sort of horror show over the last 6-7 days, especially if you were a trader. And what we have as we come back this week into this, once again, a holiday shortened week, because Friday, once again, is a market holiday, is a much more comforting screen. Now, I'll just start with some of the news flow, which I think are important to take note of. There are reports which say that India and US officials have begun sector-specific trade talks virtually, and they will sort of really get into the thick of it. Maybe there will be in-person meetings as well. Japan-US meeting is this week. This may be the first country to get a deal. It's widely expected that they may be the first country because they reached out first. And of course, I mean, they've been very conciliatory, etc. And I think the reason why it's important is to track this is because this will give you a template of what they are ready to do, what they're not ready to do. And I think this may be, at least the markets may jump on it with some vigor, depending on what gets done. Now, Trump said, and this is, of course, whiplash over the last 2-3 days now. First, of course, I mean, there was that notice from the U.S. Customs and Border Agency, which essentially put a pause on the tariffs on electronics, smartphones, computers, etc. Then Trump came out and said that the pause was temporary because sectoral tariffs were coming, because they've moved into another tariff bucket, apparently. So, again, there was reprieve, but there was this caveat as well that the reprieve is only because there are specific tariffs which are coming. Last night, Trump suggested relief for U.S. auto companies, but reiterated that pharma tariffs were coming. So, this is a little bit of this, a little bit of that. But one thing is clear, they're very set on sectoral tariffs from here. I mean, some of these, of course, they've labeled under national security considerations, but sectoral tariffs are very much coming. In what shape, form, size, we will know. The big question for markets is this. The reversal that we've seen, is this a full reversal? I mean, first of all, full reversal in policy. When I say reversal, I mean those, 100, 70%, 76% kind of tariffs across countries. They've kind of gone back. Now you're starting with a baseline of 10% tariffs across the board, and then you perhaps will look to put on tariffs on top of that. It's really tough to gauge policy direction, of course, because of what is being said. In a way, this is a situation where it is much better to follow what is done rather than what is said. And I think we really need to pay attention to what finally happens, because a lot what was said will happen has been reversed already. So in that sense, it's very difficult to go on the basis of what is being said now. What is clear is that markets seem to have found a point of reflexivity, which is nothing but basically we know where the put is. We were all talking about where is the Trump put. Maybe the Trump put does not exist for equity markets, but it certainly exists for bond markets, which is what has essentially forced Trump and the Trump administration to pull back from the brink. So we know that markets and market reactions matter. So there will be that reflexive kind of action which starts to come in terms of pulling back from the brink, like what we saw last week. The Fed also had a few things to say. So the Fed, Collins said that the Fed is absolutely ready to help stabilize the market. This was, I think, on Friday. Then Waller last night said that the risk of recession could outweigh the risk of escalating inflation. This was read at the margin as being slightly dovish. Market implied odds for a recession are still around the 50% mark. So it's like a coin toss. So really difficult to kind of plan for anything in an environment like this. And we will, of course, have to track this hour by hour because commentary seems to be that way. Now, I'll just having said all of this, we are, of course, in a much better place now as compared to what we had, where we were, last Tuesday, Wednesday, etc. I mean, things may change still yet, but the point is we may, at least in terms of sheer volatility for now, have seen the worst of it. Now, just some levels here. Nifty last Friday broke above the previous high of 22,697 and 22,806. 22,806 is the 50% retracement of the previous fall. The next target is 23,057, which is the 61.8% retracement of the fall. So that's the next immediate resistance which comes in. Nifty Bank has got major resistance between 51,307 and 51,360. We made a high of 51,244 and then have seen some selling pressure. So this naturally becomes a resistance to beat. And on the way down for the Bank Nifty, the support comes in at the 20-day moving average, which stands at 50,434, and the 40-day exponential moving average, which is 50,079. The GIFT Nifty will come up on your screen. And of course, it's indicating a gap up as opposed to where we left off on Friday. You are reacting to much better screens, much better markets around the globe. Surabhi.
Absolutely. And even I saw that Christopher Waller comment, Prashant, and it's quite interesting. He's saying that the effects of inflationary effects of these tariffs, they'll be transitory, and that was widely picked up by the press. Yeah. So he seemed to be striking a very dovish tone. Just to go back on the commentary that President Trump has been sort of giving out to the market since last night. So we picked up the more operative parts of that big, long social media post that he put up. And this is after what some people called was a bit of a rollback on electronics and semiconductors. He says nobody is getting off the hook. And he goes on to say, especially not China, and which by far treats us the worst. So the commentary and the language is also very hawkish, at least in the social media posts. And he said that there's no tariff exception announced on Friday. These products are subject to the existing 20% fentanyl tariffs. They're just moving to a different bucket. Then he says that we're taking a look at semiconductors and the whole electronic supply chain in the upcoming national security tariff investigation, giving a sense that there could be more coming on electronics and on semiconductors. So then he again reiterates, we need to make products in the United States. We will not be held hostage by other countries, especially hostile trading nations like China, which will do everything within its powers to disrespect the American people, etc., etc. So the tonality of this message that was put up did not seem very dovish or very reconciliatory. But let's see what eventually comes. For now, it seems that there's a bit of a tariff reprieve on semiconductors and on certain electronics as well. By the way, on autos, again, his quote was, I'm looking at something to help some of the car companies that need a little bit of time because they're going to make parts here, which is giving some hope and expectations for the auto space. Auto stocks, by the way, last night in the US were up. Ford, GM, etc. All those shares were up 2-3%. But as a lot of this rolls on, let's not forget that there is legal action as well. There is another suit now that's been filed. This one is in the US Court of International Trade against tariffs. And the people who filed, a bunch of businessmen who filed this lawsuit What they're saying in this suit is that tariffs have been imposed illegally, and the trade deficits, which have been on with several countries for many decades, they don't justify necessarily an economic emergency. So all of this is ad hoc, arbitrary, and illegal. Let's see where the suit goes. For the time being, Asian markets are only building onto gains. Monday was a very good day in Asia as well. Most markets were up between 0.75% to almost 2%. And this morning, we're seeing more of the same. The Hong Kong market is actually the one that's a little quiet. But if you're looking at the Japanese markets, if you're looking at some of the other regional indices, Singapore, etc., they're still up and about. Hong Kong and Shanghai, these are two markets which have broken away from this rising tide, so to speak. By the way, in South Korea, there's already an announcement for semiconductors. The government there has announced a $23 billion package to support the semiconductor industry. In currencies, Friday saw big peaks, massive peaks on the yen as well as the euro because of the risk aversion trade. Now, over the course of yesterday, last night and this morning, these currencies have cooled off a little bit. The dollar is trying to find some ground. The peak on Friday for the euro was 1.14, and the peak for the yen was 142.05, and these were the high levels. From there, these currencies are slightly lower. Now, on the point of this all-important meeting, the Japan-US meeting, just a couple of things. The Japanese Prime Minister yesterday actually struck a bit of a mixed note. He said that there are no plans, Japan has no plans to make big concessions, and we're not in a rush to make a deal this week itself. And why do I talk about this week? Because the Economic Revitalization Minister of Japan, he's traveling to the US and he's likely to meet Scott Bessent as well as USTR Jameson Greer as early as Wednesday. So let's see if we get a deal out for Japan or not. And finally, on the oil markets, by the way, OPEC has cut its forecast for 2025 and 26 by several million barrels. So let's see how oil prices do. Goldman Sachs came out with very sobering targets on oil as well. Now, where does this leave us? I was mapping the recovery from the lows, the lowest point of this tariff fall for markets around the world. And actually, we've not recovered at all. I mean, the other markets have recovered, big time. 8 to 9% recovery, almost 75% of the fall has been recovered by the US indices in the last couple of days. We were shut for a couple of trading sessions, so we're behind the curve. India is up only 3% from the April low. So will we play catch up? Will the bulls really charge on the street? The only caveat to that is that the charging bulls still have to deal with negative FII flows. The selling on Friday was about 2,500 crores. Domestic institutions or buyers, so that was a big help. They bought almost 3,800 crores in terms of cash markets. So let's see the flows picture. And finally, results season is also beyond all the tariff headlines. Results season is in full bloom. Today, we'll hear from companies like ICICI Lombard, ICICI Pru, as well as IRDA. So plenty to keep us busy today, Nigel.
Well, that's right. Let's start off, though, with the troika. Brent crude prices are well behaved despite those cuts of forecast overnight. And Brent crude prices being stable, not falling off the cliff, that is not such a bad thing, actually. From an Indian market perspective, it's good. But from a global perspective, if Brent crude prices slides more, that's indicating a big recession globally as well. So it's holding around the $65 per barrel. The dollar index at a 3-year low, so that's good news, sub the $100, the 100 mark, which is good news from an Indian market perspective, an emerging market perspective. And the bond yields, that cooled off. The US bond yields cooled off by close to around 15 basis points from the highs that we saw a couple of trading sessions ago. All eyes are going to be on that meet between the United States as well as Japan, because Japan holds more than $1 trillion of US debt. So that's going to be important. But this one cooling down, that's good news as well. Moving to the FI positioning. Well, they sold in cash market, close to 2,500 crores odd. But that long-awaited short covering bounce, that's finally coming about. Because we did see that the net short positions went up by close to around 4 times from the start of the series. And they got the positioning right, because actually the index gave off close to around 1,000 points. But in Friday's trading session, we had a short covering bounce. There was close to around 15,000 contracts that got covered out on the short side. And we did have a bit of a bounce as well. So first signs of short covering that we saw in Friday's trading session. Moving to the positioning, the FIs, well, they're still net short, close to around 75% of their positions on the short side. That number was close to around 79%. What did they do on stock futures, though? There was short covering yet again out there from the FIs. They covered close to around 13,000 short contracts. They added close to around 65,000 long contracts out there. And even the client positioning, they added more longs than shorts on stock futures itself. And remember, both the two big participants, they are net long on the stock futures side. Options data comes up for you on the screen. 2 strikes were active, 22,800 call, 22,800 put as well. And just going by both these 2 strikes, there appears there's a bit of a short straddle at play. What's that? You write both the strikes at this, both the call as well as put at the same strike. That's a 22,800 odd mark. And you're looking at a broad range because you're pocketing close to 450 to around 500 rupees. So you add 500 points to around this 22,800 and you subtract that as well. So that's the broad range, but you'll want the range in the near term, right? So given that the GIFT Nifty is suggesting a gap up, in the near term, you'll want the Nifty today itself to conquer the 20 DMA, the 50 DMA as well as around this 23,000 odd mark. So you'll want to close above that mark. The start's going to be in the green. You want to close above that. And going by the options data, the 22,500 mark becomes very important. The Nifty Bank, that's been the driving force. As of now, it's conquered all the technical levels, 20, 50, 100 as well as 200 DMA. So that one will have to drive on from here on and head towards that recent high of around 52,000 odd mark. So yet again, the start's going to be positive. By the end of the trading session, you'll want to end closer to the high point of the day, like we saw in Friday's trading session.
Okay, all right, Nigel, got that. Thanks very much. So those are the cues with which we are starting off. Let's also get you the equity call of the morning. And this one is coming in from Morgan Stanley. Rhythm Desai of Morgan Stanley says India's low beta is helping it to significantly outperform amidst the global sell-off, even while the index could reach multi-month lows. He says key India-specific catalysts include continuing dovish actions from the RBI, stimulus through GST rate cuts, a trade deal with the US, and incoming growth data. He says their new December 2025 sensex target is 12% lower at 82,000, 9% above the current level.
Well, we've got one more call. This is Alexander Redmond of CLSA who says that their base case is now for a Trump-inflicted US recession. He says with record high policy uncertainty, corporate and household confidence cratering, freezing investment and all, but ensuring a self-fulfilling US recession. He adds, forward employment surveys are already deep into contractionary territory, adding within the chaos emanating from the White House, they have sought protection in Asia-Pacific markets with moats for 2025.